It's just past the top of the hour, and that means we are about to bring in Brett Manning. You all know him as Chart Trader. You can find his work under the trading ticker CHART. Just do a ticker search, and you can find his calls and some of the things that he likes to talk about. It gives you some pre-market prep and whatnot. And I'll step out of the way and let Chart Trader introduce himself, give us a little bit of his background and his trading style. Welcome in, Brett.
Hey Jim, how you doing?
I'm doing quite well. As you know, we do have some new listeners and maybe some listeners who may not have been with us for a little while, getting back up to speed to the briefing product. So I figured, since it's your first opportunity in this in our new open access, why don't you give us just a quick little summary of your trading style, your background, and some of the markets that you key to focus on.
Sure. Well, I've developed a very top-down, macro-discretionary approach. I've been a trader for about 20 years at this point, and I started out programming trading systems for futures markets back during the dot-com crash. And that gave me a lot of a kind of intuitive sense of charts. Even though I didn't come up with a holy grail system, I found that by trying to break it down, I spent like 3 years trying to break down and find the holy grail, as anybody who starts out that way will end up doing. And eventually, I started to figure out why it's not going to be possible to find a holy grail. But I think staying at it and getting into some really arcane methods of trying to define patterns and using fuzzy logic and a lot of arrays and things like that, I started to develop a sense of certain principles as I started to hunt for different types of setups. And so that really did help me try to figure out more about the way that markets work in terms of different time frames and different recurring patterns of behavior. And as time progressed, I started up bottom-up trading individual equities after that for a period. But really 2009, 2010, I really kind of became more devoted to a top-down approach and to sticking with futures markets. And at this point, I trade equity index futures, I trade commodity futures, fixed income futures, and currency futures. And that's principally what I focus on. And I will say the main thing that probably characterizes me and differentiates me from a lot of other traders is I really like it, and plenty of guys do, but I really like it when the VIX is higher. I find that the opportunity is much greater. I tend to trade more often and even at times bigger size when the VIX is above 20 or even above 30. And if you do a ticker search under chart, you'll see my pattern of activity being not very active in September, but getting increasingly active in October and November, and then extraordinarily active in December. And December was one of my best months in a couple years, and it really seemed to kind of tee itself up for me. I was bearish coming in, looking for a plunge to the downside, and then when we turned, I was pretty much able to get on board with it and start going long for the majority of this bounce. So it's been a really terrific period, and one other tendency I have is to slow down my trading as we get into the first 2 weeks of earnings season, because I find that the number of different inputs that are defining the patterns intraday, the game becomes a little bit more complicated because you have longer-term, independent-minded decision makers coming out of meetings, with strategy sessions and committees at major funds that are making some big decisions that aren't really in response to what's just been happening in the market over the last hour. So you've got this kind of nested, multi-level logic that's defining patterns, and it tends to be a little bit trickier in my experience to trade that period. And usually, when we get past about the 2 week point in earnings season, I tend to pick up my activity again, and we're getting close to that now. So that's probably what we'll see here. But one of the main things that I'd like to emphasize, a characterizing point for me, is the reason why I believe that there's more opportunity when the VIX is higher is because decision-making becomes more reactive. And the way that I've explained this in the past is I like to think about, and if you're new, you'll notice I use a lot of metaphors and analogies in how I explain things. It's just the way that I think. But if you think about like a city square and a big crowd of people in that city square, and you imagine one or two people looking sort of up and to their left with a really surprised expression on their face, and then other people start to do the same thing, and then the people who do that start to run to their right. you can imagine the way that other people around them will start to react. They don't know what's going on, but they've started to see a sign from enough different people that there's something really problematic going on in the sky over to the left. Maybe, who knows, maybe it's a bomb or something. But everybody's starting to run to the right, and so people start to pick up on that and turn and run to the right, even if they don't know why. And I would say that that is a simple explanation for the same types of things that you see when the market gets extremely volatile. And also the reason why I think it's more easy to trade. You get a feature that I call serial correlation, where the market is correlated to itself over time. The patterns become more intensely patterned, and the trigger points tend to reveal actual changes that then give you follow-through. So it's not just that the ranges are wider, it's that the behavior tends to be something that feeds on itself in both directions, because information is really important. Because the moves are big, any information about what's happening in the market is more and more important as the moves get bigger and bigger. So information is really important, but it's really uncertain. So when information is really important and really uncertain, people tend to key off of each other. Just like the people in that crowded little square, right? They start to key off each other because they can tell that this could be a life or death moment, but I don't know why. And I see what these people are doing, so I'm just going to do what they're doing. And the market tends to behave the same way when volatility goes up a lot. People are winning and losing lots and lots of money, and so that makes it really important. But they don't know why the market's moving like it is, and so they start to follow everybody. So if the market starts to run to the upside, people start to buy. If the market starts to dive to the downside, people start to sell. So if you're somebody who can separate yourself from the emotion of that and just start to analyze it, the analysis pays off more than at any other time. So I really like markets like that, like we saw in December, and I think that kind of philosophy defines a lot of what I do. And one of the other main
Hey, Chart, are you still there? I think I lost you. Yes, I got you.
Am I back?
Yes.
Okay, all right. Yeah, I had a little hiccup here. So one of the main things that I try to focus on analytically that a lot of people don't, and that I think is super important, is sentiment data. And it's the reason why I was able to get bearish when I did in October and November and stay bearish through December and then turn around and get bullish just after Christmas, 27th, 28th. One of the main reasons why is because I follow sentiment data so closely. And for me, sentiment data means information about how people feel about what the market's going to do. And I focus on surveys, and I focus on options data, and I focus on futures positioning, and a number of different interesting indicators that I use. And you'll notice over time what those are because I talk about them a lot. This morning, for instance, I talked about the VIX futures term structure, which really, so the VIX, the volatility index is an index of options volatility expectations on the S&P 500. Actually, the S&P 100, I believe. But the point is, or actually, it's off the SPX cash. But the point is, there's also a futures market that trades that, and so it has to hit expirations and be arbitraged to the actual index, the VIX index. So the futures can't get too far away, but it tends to show when people believe volatility is going to be greatest because there's a number of different contracts for the VIX futures market. So there's the contract that trades for the VIX 3 months out versus 6 months out versus next month. So you get a sense of when people believe the volatility is going to be most present by the relationship between the pricing of those different contracts. So the term structure is really the curve of the different VIX prices as you go from one contract to the next, looking further out in the future. And typically, if you just think about it philosophically, further in the future is always less certain than tomorrow. You know more about tomorrow than you know about 3 months from now. So the VIX futures market tends to be chronically in a state of what's called contango, which means each futures contract is priced higher than the one before it. So as you go further out in time, the VIX is assumed to be higher. It's just a measure of the fact that the future is more uncertain than the present or the next day. But sometimes, in very strange situations, like when you have a market crash, that flips, and suddenly next week is seen as being more uncertain than 3 months from now. And usually, that's when you have in place what I call a catastrophe hedge. People believe that it's possible that the market could have some kind of dislocation, and so they're amping up their options protection on the S&P 500 price for right now. And so that escalates the volatility pricing for those options and increases the VIX and increases bets in the VIX futures. So sometimes you get these strange situations where this coming month's VIX is assumed to be much higher than 2 or 3 months out. And that's a situation when you know there's a lot of hedging in place. So one of the things that I looked at this morning and late last week, and also when we hit the lows in December, was just a huge skew there. When you have people massively hedged for something that's just about to happen, the odds are it's not going to happen. So when we got to December 24th and December 25th, the data was suggesting that people were massively hedged for a further crash, for a 1987 style event that would happen out of that. And when we got to that kind of state of affairs, I basically knew that we had a bottom, because there's no way you're going to see one of the most historically skewed backwardations in the VIX futures term structure before a crash happens. That's when people are overly prepared for a crash, which is usually a good time to take a contrarian view on the market, which in this case was to the long side. So sentiment data is something I study very closely, and it's helped me in a lot of situations, and you'll see me do that on a daily basis. So I think that's a pretty good summary of my philosophy and my background.
Yeah, the only thing that I have really garnered an appreciation for in your trading style that you may not have mentioned is your application of game theory, and you apply this to many markets. And I think when you analyze the sentiment data and you really do kind of look for that crowded square type trade, especially when you're looking at the mentality, you really put in a lot of analysis and detail to which way you think the market's going to be positioned based on a variety of factors. And then you structure your trade. You really tend to form a hypothesis in which then you can find another word that I stole from you, falsifiability in your trading. And if you could just expound on that just a little bit, because I think that's a very important thing that I got from you that I applied to my own strategies that has really helped me, and I think it will help other listeners as well.
Yeah, so I mean, I'll start with falsifiability because I think it's probably something that people have underappreciation for in their trading, and it's one of the reasons why I was able to really break through and see a lot of really sustained success is when I started to feel that was the most important element in any setup. And the way that I would describe falsifiability is the most important thing about any trading setup is to know at what point or what signal will tell you that you are wrong, and to look at the world that way. So I find when I see something and I say, oh, this is a really good setup, usually the reason I believe it's a really good setup is not because I'm sure it's going to go the direction I think the market's going to go, but instead it's because I'm really confident about a particular point in which I'd be wrong, and that point is not too far away, which means I can risk a small amount and know that if my stop is hit, that I'm not going to get caught in that cycle of putting the trade back on, taking it off, putting the trade back on, because I find that those sorts of cycles can be the most destructive thing for traders. And really, it's about finding setups where you know very clearly that you're wrong when you're wrong. And if you start at that point, then when you get into something where you've got a strong market bias, and you also find a highly falsifiable setup. So the larger time frame sense of, for instance, having a really strong sense that the market was going to move to the downside in December and break under those November lows and really break down, I was able to hit a number of big trades on the short side because I had a very strong bias and sentiment data supported it. We had recycled back to some bullish sentiment right before the crash, which is a beautiful situation if you're bearish. And so I had a strong bias, but it's not just about the bias. It's also then taking that bias and applying it to chart analysis and then finding situations where you've got a strongly falsifiable short time frame setup in the same direction as that bias. So I know that I'm wrong if there's a bounce of such and such size in this situation because in my experience it shouldn't happen here. So I can easily put a close stop and get short. And now I'm trading with my bias in a situation where I won't get caught in that cycle of putting it on, taking it off, putting it on just because I feel the market's going to go down. And it's discipline in applying that sort of two-level analysis. You've got your bias, and now look for setups. And setups are drawn based on or understood based on where you have strong falsifiability, knowing when you're wrong. So that's the falsifiability part. As far as the game theory part, I think that really, I'm just sort of a game theory junkie, and I tend to think in terms of imaginary hypotheses about how a randomly understood agent in a system would behave, and I try to kind of come up with a hypothetical understanding of what's going on underneath the tape in terms of my characters. If you think of a stage play, my characters are strong-handed longs and strong-handed shorts, and weak-handed longs and weak-handed shorts. And so there's those basic four groups, and each one of those groups can be either flat or in their position. So the weak-handed shorts can be loaded into the market, and therefore that gives a very strong possibility of a squeeze. And the difference between a strong hand and a weak hand, really quickly, is if you think of a strong-handed long will buy more when the market goes against them. A weak-handed long will get out when the market goes against them. So I would characterize most traders, and myself included, as a weak hand in whatever I do. And I think that's been a very profitable thing for me. Weak tends to be a derogatory term, but it's not in trading. I think you want to be a weak hand if you're a trader. If you're an investor, it's a little different. But if you're a trader, you want to give up on things that aren't working relatively quickly so they don't really turn into monsters against you. So there's weak hands on both sides of the tape, there's strong hands on both sides of the tape, and they're either in or out of the market. And I think of those different states and those different characters as forming a kind of puzzle. And I do a lot of tape reading, and I do a lot of analysis of sentiment, and I do a lot of pattern reads, and it's all for trying to come up with a base philosophy about who is driving the ship in terms of those kinds of formations. Do we have a crowd of who in which direction? And coming up with a kind of puzzle and then disentangling it and developing hypothetical understandings of those things. And that's part of how I get my bias, right? And then it comes down to chart reading and tape reading and falsifiability as far as defining setups. So a good example is during the rally. Even though I was bearish in December, I got a bit bullish on this rally, and there were times when I was ready to see the rally stop, but based on sentiment data, I got a strong sense that there were a lot of really strong-handed longs. The selling in December got so intense that there were a lot of really strong-handed longs that got shaken out of the market. They got shaken out of long-term investment plans. And a lot of this bounce was really the process of a competition between a lot of people who wanted to be back in the market but wanted to buy in a dip, wanted to buy in a retest to the lows, and so they just ended up chasing the market up and competing with each other, making the dips smaller and smaller and smaller, because they were competing with each other so hard to get a piece of the market on the dip to rebuild investment portfolios that have been shaken out on the intensity of the dive and all of the extremes of bearishness that we saw in terms of sentiment as we came down to the lows in late December. And people were really looking for that big crash. You could see it in all the data. And so a lot of people just simply threw in the towel on a lot of positions that were important to them. And when we started to see signs and data that we weren't heading imminently into recession and that earnings season maybe wasn't going to be that bad and the market started to spring back, I think there was a lot of fear of missing out from some strong-handed, longs that were looking for long-term positioning in the market and have gotten shaken out. So I think that's why the bounce was so pernicious to bears who were trying to fade it all the way up. And we've got sentiment data suggesting that in terms of flows from leveraged ETFs was a really big sign we talked about last week. I think we had something like, what did we have? We had, here it is. All right, so we had leveraged long equity index funds, so ETFs that are leveraged on the long side. Over the course of the bounce from December 24th to about January 18th or so, leveraged long equity index funds lost over $500 million in assets under management, and leveraged short funds saw a cumulative inflow of $523 million. So basically money was going from leveraged long funds to leveraged short funds as the bounce progressed. And that just shows you there's a lot of even retail money that had just decided this is it. I'm going to make my money by fading this bounce. And they were doing it right into the process of a lot of big money that had gotten shaken out of a lot of important positions competing to come in on bounces. And it just made for a very difficult to fade, very aggressive, grinding kind of really tough to stay with kind of rally. But because I had that bias and because I used that data, I was able to consistently buy most of the way up each day, finding a setup, finding falsifiability, getting in and making money on the long side. So that was a good example of how I kind of combine those ideas in terms of falsifiability, game theory, and sentiment data.
All right, so now that we have some of this strategy and the formulation of a trade out of the way, let's talk about where you are in the markets currently. So let's talk about yesterday a little bit, because you had a short bias coming into the day. You were able to put on a short in the mini NASDAQ futures, made a good gain, I think 40 points on the last piece.
Yeah, that's a lot on the table, but yeah.
Yeah, and that's okay. So Today we come in to a market that rose up to the 2650 level. I believe if you didn't highlight it, I know Gavin and I did as a key resistance level that might get tested and whatnot. But you didn't
Right.
come out with a new short today. So what was your
Right.
thinking coming in as to why you didn't want to jump back on the short bandwagon, and just your overall thought process in that?
So I thought about it, and I said pre-market that technically the situation looked like it favored a short bias coming in today. One of the reasons is we're in a point that I call a correction of a correction. So if you think of the primary trend right now as up over, you look at like the 60-minute chart, then you pull back into that yesterday in a way that I believe, I drew a wedge pattern in my notes yesterday morning, and a wedge is a really interesting pattern and an important pattern, but the idea in that situation was basically that the move on Friday into the highs and then a little bit in Sunday night, in terms of where we were hovering in that pattern, was above the blowout point for that wedge, which generally leads to a move back down through the bottom slope line of that wedge, which we did then. It's one of the reasons why I shorted the NASDAQ yesterday. And that should lead, as I believe, down to the 2600 level. I said that yesterday morning, and I said it again earlier today and later in the afternoon yesterday as a logical point to see that wedge blowout reversal correction process go to. And, by today's action, it looks like that's kind of what we're doing. But because it's a correction of a correction, in other words, the bounce was aggressive enough overnight, it puts it into a muddled state for me. And given the fact that we're still kind of in the thick of the initial response to earnings and still getting a beat on that, I just decided today that it was a good idea to really do a lot of just watching the tape and trying to restrain myself from putting trades on. Unfortunate, because it really turned out to be an aggressive move, and there are probably instances where I should have been active. But I've been really active lately, and I wanted to really just kind of observe things given where we are to understand whether or not I should shift my bias and become more aggressively bearish. One of the confounding parts of that right now, I do a lot of analysis of just macro events as well, and one of the ideas that I've had as an important part of how I formed a lot of my hypotheses about the market is in the trade war. In the negotiations between the United States and China, I've had a relatively firm belief that China's behavior makes the most sense when you look at it through the lens of essentially that they're stringing the White House along and that they want to continually make it look like they're engaged in a genuine attempt to find some kind of resolution, but that they really don't want to find a resolution to this. And that they're playing a long game, which basically means having a different administration in the White House is really what they're interested in. And this is the first really China hawkish, protectionist administration that we've seen in this country in decades. And really, they're kind of just weathering that, I think, because they've got a 10, a 20, a 30, a 40, a 50-year plan, and that tends to be how China politics works. It's a much more long-range kind of thought process. And Xi Jinping has been elected leader for life, and he's got an extraordinarily strong hold over the Communist Party in Beijing, and he's not the least bit vulnerable, even if they go into a recession from here. Whereas the Trump administration is heading toward another election right now, and the idea that there would be something that Trump could take back to his base and say, this is a victory. I said we were going to solve this China problem, and we did. Would probably be really important for his electability again in 2020, and China probably knows that. So to make a lot of concessions, to change things for the future, to give in and give Trump a win, would likely have 4 more years of Trump and have a much worse trading situation at home, versus to try to weather this and keep stringing the United States along. Keep saying, yes, we're going to make an agreement. Yes, we're definitely thinking about this. Yes, we're going to come and talk about it, to try to slow down the rate of tariffs. Just slow it down and just kind of bide time. And that's been my philosophy as what makes the most sense from their perspective, and it also seems to be, as I observe the headlines each day, what it seems to be happening. And so right now, I think the last couple of days, we've started to see an intensification of headlines that suggest the sort of White House believing that things are going really well and heading for a March agreement. We've kind of seen a big hiccup in that, and a lot of things coming out suggesting that it's not going well, and that there's really not been any sign of further concessions from China. Just a lot of sort of lip service toward that direction. And Trump is getting frustrated again. We're having to talk tough, and we're reinforcing the idea that the Huawei CFO is going to be extradited for trial in the United States and all sorts of stuff. So I think the market had gone through a process of maybe believing the hype that the end of the trade war was near, and now it's going through a process of realizing that that's probably not the case. And so I think that's impacting the action, particularly today. And so it's tough to disentangle and understand whether or not this is just market dynamics pushing the market down, or if it's a reaction to an evolution of that idea.
All right, the next key areas you're going to focus on in terms of, I guess, technical levels. I know you look at sentiment and whatnot, but we've highlighted this 2620 area where it's currently trading, the 2650 area. Any interest above or below those particular levels?
Say it again?
Above or below those particular levels that we highlighted. So let's say we break down to the 2600.
Right.
Does that start to pique your interest as far as a long, or how do you handle it, say we get there?
I'll tell you what I would love to see. I would love to see 2560, but I don't know if that's going to happen.
Okay.
And I really think that, I'd love to see that, and then just, a real extraordinary build in bearishness. Again, one of the things that I've noticed over the years that can be one of the best trades you can put on is a situation where you've got a lot of bearish sentiment, and you get a higher low on even more extreme bearish sentiment. Now, that's going to be really a tall order given how extreme the data got at the lows around Christmas time. But if we get something that's even anywhere near close, we get a real puke back down, we get 2560, 2550, and we get some more serious extremes, that will probably be a really particularly fantastic long trade opportunity. But, imbalances and extremes are always the best opportunities, and a lot of times you have to make do with different versions of that aren't quite as far up the spectrum. So if we got to 2600, I would consider that to be the sort of first level wedge target as far as kind of blowing out that pattern and possible buy point. And I would try to get a sense based on how the tape is reacting, particularly the headlines and just the order flow going through and any sentiment data signals that I get to see whether or not that may be the next point where a lot of this, what I'm calling this, the long-term strong hands who got shaken out in December are starting to really come in again and accumulate. And if we get that situation and we maintain the bearishness in terms of short-term traders, then probably you'll get some squeezes off that level. But I try not to get overly planned out in my levels. I really like to think about not where you get, not what the levels are, but how you get there. The mode of behavior of the market on its way there is usually more important to me than where it gets to. Mm-hmm. So it really just depends on how the pattern evolves.
All right, so safe to say that at least for now, you're going to sit tight in equities, wait to see how things unfold over the course of the next few days or so, see how the levels play out and how sentiment comes out. Mm-hmm.
Well, it is possible that, so here we are about midway through today. We've had an aggressive move lower, a morning move, and now we are retesting key levels. We're retesting the 50 days, and it's definitely possible that into the close will be a short setup today, depending on how this bounce patterns itself out. And I just need to watch it. And just basically, if I just get that feeling that there's just a lead blanket coming down on top of the market, and there's a bunch of people coming in trying to buy it, and they're gradually losing the equivalent of an arm wrestling match in terms of how the pattern forms, and then we're probably going to see another puke into the close, and that might get us close to that 2600 level. So there's a possible trade, but I really need to see how this process, because right now we're kind of in a consolidation, upward moving correction of a downward intraday trend. And, we're either going to see some kind of V-bottom or we're going to kind of progress and show that lead blanket offer we're still weighing on things and gradually build up vulnerability in the form of weak hands coming in, trying to buy and eventually getting pushed out. So we'll see how the process develops, but it's possible that we'll have a short trade into the close today. Otherwise, it's going to be interesting to see. We're in this kind of correction of a correction of a correction now, so there's going to be a lot of chop to filter through in your mind, but we still got a nice VIX level, so there's probably going to be plenty of opportunities.
All right, well, we'll certainly be waiting for any of those opportunities. I do have good news for the listeners. Tomorrow, we're going to have a roundtable discussion with Brett, chart trader here. I believe Gavin, blue chip trader, maybe scalp trader. So we're going to get the whole band together and do that. So we're going to be able to pick up where we left off, Brett, come tomorrow, barring any setbacks, right?
That sounds good.
All right, my man. Thank you so much for jumping on, getting us up to speed as to where you are in the markets, and maybe even giving us a little preview as to how you may look at the markets as we head into the close. Thank you as always, Brett.
You got it. Thanks, Jim.
All right.